Valuations are falling, but India is an expensive market. We have to get back to the debt market tangle because it's tangling the equities, almost strangling the equity markets. For a check on the latest ground situation, Sunil Subramaniam, Managing Director and CEO of Sundaram Mutual Fund, and Prabodh Agarwal, Group CFO of IIFL, in a minute. Okay, they are already with us, so we'll go over to them. Well, first up to you, Sunil. What's the situation on the ground? Have there been any redemption requests at your desk? But more importantly, what is your industry telling you? Are people calmed by the regulators' press release, or are they still coming for money?
No, I think at our counters we are not facing any redemption pressures, and from what we hear from the industry, I don't think there is any sense of panic. Yes, because if you look at the industry where it's raised the money, right, a significant portion of that is in FMPs. And about a few years ago, SEBI changed the rule saying that FMPs you cannot take out money before. Whereas a few years ago, during the previous crisis, you could pay an exit load and take money out of FMPs too. So at that time there was a sense of panic in 2013 because a lot of people were willing to pay the exit load and get out of these long-term holdings. But today on FMPs you have to wait till maturity, and a significant portion of credit risk has been taken in these buy and hold kind of papers. So I think that eases the burden. That being said, at Sundaram we don't have a medium-term credit fund. So all our 95% of our portfolio is in AAA rated securities. So in that sense, we don't have a medium-term credit accrual fund where investors could be taking this call. But our sense of talking to the industry is that there is not yet a panic situation. I think the RBI and SEBI's efforts have actually played a very laudatory role.
Okay, Prabodh Agarwal, the Group CFO of IIFL, is also with us. Prabodh, would you concur that, it's not a time to panic? And what are you seeing in terms of any kind of redemption pressures?
Yeah, so of course, I would agree that it's not a time for panicking. And of course, it has been triggered off by certain, events at a corporate level. But it's good that the regulators, the RBI, came in and made a press release that, they would step in and avoid any kind of a liquidity crisis. See, we at IIFL Group, we are very comfortable with the liquidity situation. We had actually planned to redeem close to 2,800 crores of CP in the last week of September, and we are planning to go ahead with that redemption. Despite all the liquidity scare and all that, we have enough lines of credit which we have planned, which will be drawn down in this week, and that will be used to repay all the CP. So we are confident that that we'll be able to repay and then raise fresh CP as and when required in the next quarter.
No, that is the point, the raising of the fresh CP. Now let me read out some numbers which Credit Suisse has just put out. For NBFCs, in the past 1 year, the share of non-bank funds has risen to 74%. Most of this came from mutual funds. And mutual funds as a whole, their NBFC exposure has increased 3 times since 2016, March 2016 to current day. The mutual fund NBFC exposure has increased 3 times. Now, Sunil, will there be a move to cap NBFC exposure on the part of the mutual fund industry simply for safety to diversify?
I think SEBI already has in place. I think there's a 30% cap on each sector. They allowed a 10% extra for the housing finance sector. Okay. So I think there is a prudent cap in place. The reason you're seeing this increase is because manufacturing cycle hasn't picked up in India. So there are not enough manufacturing companies issuing paper, one. So NBFCs naturally, because retail consumption is growing and retail finance is growing, they have felt the need for funds, and hence they have come to mutual funds to raise. So I'm saying this is a natural market phenomenon which has happened, and I think there are enough checks and balances which SEBI has put in to curb sector-wise, sector-specific exposures. So I don't think again that there's any need to overreact and cap anything right now.
Okay. Prabodh, how do you see the appetite? I mean, for instance, next quarter, do you expect your CPs to be picked up? If they are not, can you all still manage? Do you have enough bank lines?
Yeah, so the thing is that, again, we take CP to the extent, we have short-term assets, so of course, the CP is used to fund short-term assets. Nearly 45% of our NBFC book has a maturity of less than 1 year, and part of that is used, is funded through CP. But, as Sunil pointed out, the thing is that, this problem of exposure to NBFC increasing is not only true for mutual fund, but it's also true for, banks. Where, banks have, again, hit all their limits, and because of the fact that there is a little offtake of credit happening in other segments, manufacturing, industrial, in infra, etc. And therefore, NBFCs have been the preferred mode of lending. The same is also true for the mutual funds. So the thing is that what now in mutual funds and banks, they have always been looking at that, but probably will be more careful going ahead, is looking at the ALM of individual NBFCs so that, to make sure that people are not taking undue mismatch in their ALM and not using this short-term borrowing to fund long-term assets. So that is something which, of course, the borrower has to be careful, but now in this situation, even the lender has to be careful.
Okay, Sunil, what about you? What do you think the government or the regulators could do now in order to sort of, ease the liquidity situation, especially with respect to NBFCs, mutual funds, etc.? For now, they've made some calming statements, but in terms of measures, would you expect anything?
No, actually, you see, it's more about making sure that there's enough liquidity in the system, right? See, basically, there are three types of risk that a credit mutual fund investor takes, right? There is interest rate risk, there's default risk, and then there is the market risk, right? So what happens is that the duration risk, right? If you take an FMP, you can control the duration risk because the papers are bought exactly to that maturity. As far as the the market risk is concerned, right? It happens in funds where before that time you need to sell. Like what happened? What triggered this panic was that because of the ILFS issue, specific mutual fund sold some of the paper. And since they were willing to take a higher price on it, right, that created a panic. So I think the issue is there is liquidity in the market at a price, every paper can be sold. Yes, there will be loss, but just like in equity markets, the share price correction is passed on to the investors. Debt market mutual fund investors also have got to be aware that any market they sell, the loss or something will come to them to some extent. So I think it's an issue of liquidity, and I think RBI will step in to make the liquidity window quite feasible so that there is no liquidity crunch in the economy.
Okay, so quick questions. I'm already borrowing from the next show's time. Sunil, are you all marking down, will you mark down, your various IL&FS and NBFC paper if today corporates were to come down and ask you for money? How much will you mark down your NBFC paper by?
See, the specific question to us is we don't need to mark down because we don't have exposure to the specific name that you mentioned. Okay. Right? The second thing is there is a valuation policy in place which takes care of this aspect. So I think that each paper will be evaluated on merits and appropriate action taken. So I don't think there's a need to panic or to give a very broad generic saying we will do an X amount of markdown because of this crisis. All right. Actually, we are completely out of time, gentlemen. Thank you very much for participating in this conversation. One hopes from what you have said that people will realize that, pulling out at such a time could be to their own disadvantage. We leave the market still in a slightly trembling note with 1.25% down on the mid caps, but much better than what they were about half an hour back. Wrap up on Bazaar, trading ideas on Chartbusters.